Good afternoon, and thank you for joining today's webinar, which will explore the potential risks AI poses to direct lending's software borrowers. New research, including our latest private credit report, can be accessed through the QR code on screen or by visiting kbra.com. Here, you'll also find information about our upcoming events and webinars. Should you have any additional questions on the topics discussed today, our business development team would be happy to arrange a follow-up call. Now, I'd like to hand things over to our Chief Rating Officer, Bill Cox, for introductions.
Thank you, Michelle. Hello, everyone. Thank you for joining us. I am glad that we have a chance to talk about our most recent research on this topic, which we published on Friday. We'll provide a link at the end of the webinar. I'm joined by John Sage, who leads our private credit research here at KBRA. And we're going to walk you through the document that we published and provide some additional commentary. So with that, it would be important from our perspective to keep in mind what the different categories of risk that are being discussed, especially in the media. And we can imagine that from a perspective of a fixed income investor in this space, it can be quite confusing because there are so many different issues going on. So as we talk about these topics today, we wanted to highlight the four areas of distinct commentary and risk and analysis that is often presented in ways that conflate them all into one confusing situation. So we're going to parse it out, peel it back. First, with regard to borrower credit quality, we have quite a lot of information to share with you, and we do so on a quarterly basis. And we can say, based upon a lot of data derived from our tracking over 2,400 middle market leveraged borrowers in the private credit landscape, who account for over $1 trillion of the direct lending debt in the market, that credit quality is relatively stable. There has been credit drift. There are rising defaults, but all within manageable expectations and certainly well within what we would have expected to see given certain risk situations that have emerged in recent years, specifically higher interest rates for many of these borrowers. It's important to keep in mind that the credit quality of these borrowers averages around B minus. So there is an expectation of high rates of default, relatively speaking, and we're well below the expected rates of default for B minus leverage companies still. The second thing to keep in mind is with regard to the ratings on transactions and on entities that are supported by the collateral provided by the loan repayments of these underlying borrowers. And for that landscape, which KBRA monitors hundreds of ratings, whether they be feeder notes or credit facilities, CLOs, BDCs, and many more, credit quality remains relatively stable, precisely because the assumptions embedded in those ratings are for rates of default that remain still higher than what we're actually experiencing. So there is stability across the landscape of rated product that KBRA monitors and continues to review in the context of current events. Third is with regard to credit investment fund return performance. Here we have been saying for almost 18 months that we expect to see greater diversity of performance outcomes based upon managers and vintages and more diffusion amongst those managers and vintages because of underlying conditions. Spreads are tighter, defaults are rising, though still manageable, and other things are suggesting that we will see greater differences in performance across the landscape of private credit investor returns. Is that an issue for ratings? In some contexts, it can be, depending on the nature of the cash flow that's being provided to rating transactions. But generally speaking, those differentiated returns are more likely to be a concern for retail or institutional investors who have non-fixed income exposure to this market. And then last, the issue that is raising lots of concerns. We have fielded calls. There are certainly lots of discussions in the media, and that is with regard to the behavior of retail investors who are relatively new to this asset class. From the perspective of fixed income investors, gates are good. Gates are there for a reason. They're there to prevent essentially withdrawals of capital that impact the ability of the platform or the fund to manage its own capital. And therefore, when we rate transactions that have sleeves of retail exposure, we expect to see gates. We model cash flow based upon worst case outcomes of gating activity, including typically the modeling of the assumption that all retail investors might leave a particular rated transaction in a relatively limited period of time. Meanwhile, gates are good for fixed income investors in this context. So with those things setting the stage, John and I are going to go into a deeper dive into how we looked at the AI issue and how it specifically impacts software companies focused on number one, borrower credit quality. John, next slide. So context. We track about 2,400 companies. They account for about $1 trillion of debt. Typically, almost all of it is provided by direct lenders. These loans are supporting everything from BDCs to credit facilities to CLOs, which is why we assign credit scores to these underlying borrowers. And of course, we track things that may be impacting future cash flow from these loans, including the impact of AI. And we're going to describe to you what we did recently and publish this report about to kick the tires especially hard on companies. Keep in mind, this is a differentiator for KBRA's data. We determine if a company is a software or technology company based upon a consistent framework of their business and business model. So this isn't as reported, which is sometimes been reported in the media as being a concern. These are companies whose business models and businesses we determine through our methodological process to be software and software related companies. So John, why don't you take our audience through what we did to isolate the companies and categorize them as high or medium or low risk in the near term?
Absolutely. So first we started with trying to get an understanding of where AI will impact the private credit universe the most. And software was obviously the first one on our list, but we also found IT and data services type companies would also be impacted. So if you lump all of those together, it creates about 20% of our portfolio, or about 495 companies. So on this slide, you can see the breakdown of those companies. You have 415 software, 40 information and telecommunications, and 40 internet and data services companies. And we wanted to go on a name-by-name basis, dig into their financials, dig into their memos, dig into the credit agreements that we have for each one of these companies to understand what the potential impact of AI could be. First, well, with the real hope of trying to understand if AI could disrupt any of these companies' retention, pricing models, margins, etc., in the next 2 to 4 years. So after going through that process, we found a couple relatively consistent buckets. So companies that help with labor-linked workflows. So things that you kind of think of that ChatGPT or Claude could potentially do better than someone in the workforce. that made up about half of the higher risk, or that was the largest concentration of higher risk AI companies. We also found content creation, marketing, sales, those type of businesses or those type of business models is where we kind of expect there to be disruption or a change in performance over the next 2 to 4 years. So after going through research, going through a lot of data within our portfolio, we then said, well, we should probably talk to the managers who made these investments. So we also went out and spoke to several software focused or within this software and technology focused sector or area. We went and talked to those managers to understand how they were looking at it and to test our assumptions to come to a breakdown within the 495 companies in our portfolio. So that we could create a even distribution across the entire 495 to then see what financial performance would look like. So we broke it down, even distribution, high, medium, low. For some of the less clear-cut cases, we really dug into what's the end market that this company serves. If it's regulated, it probably is medium or low. If it isn't regulated, so consumer space is a great example, media is a great example, it would probably end in the high space. The vertical specialization, so if it's very, very technical or very, very specialized in a specific area, that probably would put it in the medium or low. And then system of record. So who holds the data, who can access the data, who controls the data is a huge differentiator for software companies and software and technology companies. And as you can kind of see here, 165, 165, 165. Independent of performance, independent of credit quality, it was just looking at business model, in market in some cases, and the rest of some of these factors. So generally speaking, the relatively high AI exposed cohort was a little bit smaller with a little bit less scale, as gauged by the amount of debt and the median EBITDA of these companies.
And John, it's important, I think, at this point to point out to our listeners that while this isn't a perfect framework, and certainly a framework that might evolve over time, it is, in our view, a much better framework than suggesting or assuming that all software companies are equally exposed and or all software companies are likely to default, which only clouds the situation further. So with that in mind, let's go a little bit deeper now with regard to the interesting findings when we isolated these companies purely by looking at their business models. That was an important point you just made. We didn't look at their financials. We looked at their business models based upon our review of their credit agreements, of the internal credit memos, and other things that we can glean in our own way about the company. But then it turned out that these potentially high impact from AI companies had some common characteristics. Why don't you walk us through those?
So these are the results. And apologies for the wall of numbers, but it's helpful to look at this on a relative basis. So the top three buckets or top four rows or columns, rows, is comparing the high, medium, and low exposure buckets. So those 165 companies. Interestingly enough, the high risk group clearly had the slowest revenue growth, the highest percentage of companies with declining revenue, the highest percentage of companies with declining EBITDA, and one of the lowest EBITDA margins. But then when you broaden the view and you look across all of the other sectors, the 165 companies would rank as the third biggest sector by count. And the performance of the relatively high exposed group is more closely aligned to the sectors that we view as performing the weakest and with the weakest credit quality. So those are in the chemicals, containers, metals, and materials, and consumer retail space. So again, completely independent of how the companies are performing. When we broke down by business model, based on some of the criteria in the framework previously discussed, when we said, okay, let's look at the median performance, so let's start looking at performance, it showed a clear distinction in those that the high risk group was performing close to or around the worst, relatively speaking, and the credit quality similar. So, Bill, maybe I'll ask you, how do you view seeing this? How do you view the consideration that these companies, they might have high risk, but they have been performing relatively poorly compared to the rest of the group?
Well, I'm of two minds, and I think we present those two minds in the paper. On one hand, I'm somewhat comforted by this outcome because it suggests that it's impossible for lenders and sponsors not to be aware of the underlying issues in these respective business models. I'm also comforted by the fact that our outreach to a variety of managers and sponsors confirmed that. Companies who are experiencing AI risk are likely to have the kinds of characteristics that you described in their business model. And unlike what is often discussed, is that this is some large, mysterious thing to come for those companies and business models that are likely to have been impacted by AI. It's well known to sponsors and lenders, and we're about to talk about what we have learned has happened to help mitigate that risk. But then I also want to know is what is going to be the forcing mechanism for these companies and their sponsors and their lenders realizing, meaning transacting around this changed view of their business model. So let's go to, oh, there you go. You went to the next slide already. So the mechanism by which we believe the realization of this problem that you can't escape from is a pending maturity. And in the case of these specific companies and all of the companies in the entire cohort, we've been looking at maturity walls and where they are for certain companies of certain financial characteristics, where they are for certain companies of certain industry or sectoral characteristics. In general, we see maturity walls just continuing to be slid further out as refinancings occur, M&A activity occurs, and ultimately smoothing things out. But for these companies, it appears a perfect example of likely not having been able to refinance because so many of them, relatively speaking, have maturities in the next 18 months, 15 months, actually, if you, in our view, look at pending maturity as something happening between now and the middle of 2027. So, John, why don't you walk through what we looked at next after we saw those?
Absolutely. So the idea that we brought to this analysis or this research piece was there's a lot of uncertainty about AI throughout the market. You see headlines every day, you see bank research and other research coming out about how this is going to result in very, very high default rates. But in reality, most of these companies aren't going to go to zero or their business model be completely disrupted or replaced in the next year or the next 2 years or so. But where it does become a little bit more interesting or a little bit more risky is when these companies have to ask for new money. And refinancings or maturity is one of those perfect examples. So we said, okay, in the next 15 months, so relatively near term, before the end of Q2 2027, how many of the high, medium, and low risk companies have a maturity where they're going to have to go out to lenders, they're going to have to ask their sponsor for additional capital. And lo and behold, the relatively high AI exposed group had the highest percentage of companies with a what we consider near-term maturity or maturity in the next 15 months. 25% of the group, which outside of consumer retail was the highest percentage across our entire portfolio. The amount of debt, 11 billion, was the third highest after commercial and professional services and healthcare. So the idea being there's a decent percentage of companies or a relatively high percentage of companies who in the next 15 months are going to have to go reach out to their lenders, new lenders, their sponsor, and say, hey, I need help with this refinancing or I need additional capital. And that's where we found the potential for the greatest default risk to arise, especially because these companies have high exposure to AI. It's investors and investor sentiment we've already seen start to change. So if there's risk off, if there's reduced appetite for leverage, if sponsors are looking at this company within their portfolio and say, maybe we should focus on others, that's where we think the default risk is. And that equates to 41 total companies, 25% of the high risk group. But to think about it conservatively, Bill, I'd question how we viewed or how you look at it from a default perspective.
Yeah. And that is the next question. That's the natural next question. So if you're writing a headline and you stop there, you might miss the most important part of this analysis. Companies at risk because of their business model, underperforming financially, pending maturity. What happens next? So first thing we do is assume the worst. And on the next slide, let's assume all 41 of those companies defaults. Now, there will be other companies that default, obviously, in the normal course of this environment. But let's just assume that all 41 of those companies were to default. If that were the case, our forward look of defaults, what we call our middle market default monitor, which uses fundamental data, not pricing data, because pricing data, valuation data, although if scrubbed properly, can be somewhat lagging or perhaps underreporting stress. We're looking at financial data, and if we've moved a company to what we characterize as near or in default, triple C minus, then the likelihood of that company defaulting is quite high. And when we look across our entire landscape of 2,400 companies, that forward look of default monitor as a percentage of count is only at 3.5%, and by par is only at 2%. If all 41 of these companies were to default, then that would move the forward monitor to 4.8% by count and 2.9% by par. If we were to expand that universe to all companies who have a pending maturity who are moderate risk, then it raises it to 5.6% and 3.5% respectively. That may significantly impact performance returns, but it does not move the needle on credit rated entities and instruments because by design, they have cushions and mitigating features to allow them to absorb defaults of a significant greater count or of par. That doesn't mean that there aren't specific entities or transactions that may have more of this or less of that. What we continue to believe is that the transmission of these default and other market condition experiences will be through returns that for some are lower than for others who may have less exposure to these risks and therefore better perform over the next 18 to 24 months on their vintages from 3 to 5 years ago. Further comfort is provided by the slide that John has just put on the screen, and that is these companies, these 41 high risk pending maturity, are so dispersed across the landscape that we see. Their debt is sprinkled, typically in small amounts across 90 different platforms and transactions, including 28 separate lenders and less than 2.5% exposure typically in any one of these entities or transactions. And there are over 30 unique sponsors. So in aggregate, the numbers may appear somewhat alarming, but by design, in rated entities and transactions, the risk and the exposure is dispersed quite nicely from our view and perspective. And then there's even better news. And I think that may be on a next slide, or maybe it's not on the next slide. I'll just talk about it. The even better news is that John and his team reached out to the managers, the lenders, or the sponsors and learned that already more than half of those 41 companies are already in the process of restructuring with their sponsor in a way that is going to lead to zero loss for the lenders. So let's say that again. Of the 41 companies we were most concerned about, pending maturity, business model having AI risk, bad financial performance, generally exceeding the poor financial performance of some of the riskiest categories in our entire portfolio, more than half of those are already restructured in a way to avoid a default and loss experience for the lenders involved in those transactions. That doesn't mean that it's all rosy. Obviously, there are equity investors or perhaps subordinate debt investors who have experienced some sort of loss. But by design, rated transactions and entities are in a position to manage through these difficult scenarios. And this is a perfect example of that playing out quite explicitly. Did I miss anything, John?
The one thing I'd add is through speaking with all of these managers, the comfort and confidence across all of them. Some of them manage hundreds and hundreds of billions of dollars within private credit, specifically within software. And they have a great view into the entire ecosystem, their entire software portfolio. And the vast majority, if there was a near-term maturity, they said, this company is performing very well. AI hasn't had a huge impact on KPIs to date. And if we do a 6-month, year, 18-month extension, in return, we can also ask for higher pricing, tighter covenants, tighter control of how this company is operating, tighter control of collateral and cash, then we will be comfortable. The risk return still seems, specifically talking to these lenders, the risk return still seems that you can find the equilibrium. So through those conversations, it gave us a lot of confidence that this is being watched, AI is being watched across the portfolio of these lenders very, very closely. Some have had a framework and have been looking at this for 3 to 5 years. So it's well understood in the direct lending space, and the vast majority already know where potential problems are, how they can address those, and finding the right risk return. By no means did we get any sense that there's going to be a huge number of defaults upcoming. By no means did we expect there to be, or did lenders expect there to be a lot of loss or a lot of additional risk coming, but it is very, very high on what they're watching, which gave us confidence from a rated transaction and entity perspective that as of right now, there likely won't be any need to adjust or any need to, from a credit perspective. But going forward, this is something that we're also going to continue to monitor.
Well said, John. So generally speaking, these risks and others that we see in the market will continue to be monitored and will evolve over time, but we continue to believe that the actual risk is relatively idiosyncratic, with rare exceptions, is dispersed and not concentrated, and that the ratings of entities and transactions will continue to remain stable for the great majority of private credit focused entities and transactions. One thing to keep in mind, I don't know if either one of us mentioned this, that the underlying borrowers in this portfolio and on the landscape of leveraged borrowers is essentially a B minus credit. A B minus credit, by our definitions, should be experiencing, on average, a 30% default rate over a 5-year window. Our transactions assume that, or much worse, typically, in the modeling and stressing that we do. So we are well within the tolerances and do not see a major change in that regard on the horizon. But there are some other things going on that we think might have some more immediate risk, and we'll talk about those. Don't mean to end on a sour note, but clearly, depending on current events, the continued elevation of energy prices, of interest rates, of inflation, of supply chain disruption that are currently beginning to unfold could have a much more direct material impact on credit of all types, including leverage credit, in the relatively near term compared to expectations of just a few weeks ago. It is something that we will continue to monitor and hope conditions do not deteriorate from this point forward, but it is certainly something that we feel has the potential to be more material than the near-term potential of AI on this market. And John, you wanted to talk about what we call internally the long tail of COVID sprinkled across the landscape as well.
Definitely the one area where we are seeing more defaults, greater defaults, a uptick is this long tail of COVID. So if you think about through COVID and kind of the results there, companies and people were spending a lot of time at home, and companies were spending a lot of money pulling through inventory, given some of the concerns with shipping and those type of things in general. A lot of those companies as well were acquired by private equity companies, and direct lenders lent to them. But this is when these companies also were at the peak of their earnings. So as people started to go out more, stopped ordering from Amazon, and inventory levels started to normalize, earnings across numerous sectors started to normalize. And that has spiked leverage, that has compressed interest coverage ratios. So companies that specifically benefited from the period during COVID, we're starting to see the unwind of some of those businesses. So relatively speaking, this long tail, this popping up of different businesses that may have or generally speaking, did receive a highly levered capital structure during COVID. That's starting to unwind. And relative to what we see in the AI space, where performance is still haven't seen too much disruption yet. The expectation is that there's enough time for some of these businesses to benefit and understand and produce their own AI offerings, that companies specifically that we're watching, consumer retail, media, chemicals, containers, metals, and materials, they're the ones that are being the most, I guess, or they're being hurt by this long tail of COVID. And that's where we continue to see some of the weakest performance and greatest number of defaults. So going forward, we're going to continue to look in those type of areas. Software, it definitely is a risk, and it's something that we will continue to monitor. But as of right now, we generally don't think it will create enough of a ratings, credit quality considerations to have any form of ratings impact.
Thanks, John. Well, at this point, we'd open it up for questions. We have quite a few. We'll touch on some of those, but we'll respect everyone's time. We've gone over a little bit. So this is a great question that we receive often, which is with regard to the market value of some private credit loans, and the existence of different marks by different platforms at the same time. And the question is, what does this tell us about the market and its foggy product class? Well, several things. One, timing is really important. Different platforms have different periods, periodical reviews. They tend to be quarterly. And sometimes what we have seen in our process of looking at loans that are marked differently, the same loan marked differently by different platforms, that they often converge over time, where one lender who holds a portion of a loan might report it and not have a chance to update it by the time some other lender reports its change in the loan score. That accounts for some of it. We've even seen different vehicles within the same platform have different values on the same loan at the same time, based upon the catch up. What we have often seen is that the catch up occurs. Are there some instances, however, where even in our observation with that context, that we believe that some loans have been marked higher for longer, for reasons having to do with perhaps disagreement about recovery prospects? Absolutely. It informs our view of different managers' practices, but ultimately the loan price is only one of many flags that we look to determine whether or not a particular loan is likely to default, or what the recovery in the context of a default may be. Generally speaking, we believe that the focus on differentiated valuations of individual loans tends to be without as much substance on things that we rate than we have seen sometimes discussed in the general public. And John, I'm going to turn this question over to you, and then we'll wrap up. Amongst the other questions, I thought this one was interesting, but might be just a clarification. Consumer retail being exposed to AI seems not intuitively obvious. Please explain.
Sure.
Or not
So,
consumer retail, chemicals and containers. Whereas consumer retail seems intuitively obvious. Chemicals, containers, and materials does not seem obvious. Please explain.
I'll go back up to this slide here, and comparing these software and technology companies or cohorts is more to show, relatively speaking. So consumer retail, chemicals, containers, metals, and materials, as an example, or just to show relatively speaking. So this is not classified or clarified by exposure to AI. We wanted to keep that very concentrated to the software and technology companies. But one thing that is kind of interesting is seeing the kind of breadth or depth that AI has started to disrupt in certain areas. And one reason why we were very, very cognizant or tried to be specific about end markets is if there is an end market that is not performing well. So one that we watch very, very closely, consumer retail is one, but the real estate market. The huge jump in interest rates over the past few years has made the turnover or people wanting to move house and home has really, really compressed that area. And there is a lot of software companies, believe it or not, that connect plumbers, brokers, dealers to the end consumer, where you can go on some app and find a plumber, find someone who can do your drywall, those type of things. So the end market itself isn't necessarily regulated, and connecting people from A to B that's something that AI can generally do. But then you layer on the end market itself has materially slowed down. So we've started to see a little bit of, I guess, weakening credit quality in those type of areas where just looking at, across the board, if you just categorize the software companies, but you need to go through and really, really understand the product. How does it own the data? Is it regulated? And what the potential impact could be on a name by name basis, which is what we completed here.
Thank you, John. Well, John and I and all of us here at KBRA hope that this was a helpful webinar. We appreciate so many of you joining on relatively short notice. We hope that the paper that we published last week is also helpful to you. And please look out for more to come. We have a great forward calendar of research on the horizon focused on this and other changing contours of risk in the private credit market. Once again, thank you.